In today's video, we are going to learn everything about smart money concept. We will cover from the beginner aspect to intermediary and to the advanced part of smart money concept. At the end of this full course, you will be able to turn from a losing trader to a profitable trader. These are what you are going to learn in today's video. First of all, you are going to learn what is SMC, smart money concept. You are also going to know why should you be trading smart money concept. We are going to look at the different market phases that we have in terms of market cycle. We are going to look at market structure, in-depth analysis of market structure. We are going to look at liquidity concepts. We are also going to look at different entry models that you can use once you identify a high probability point of interest. So without wasting time, let's dive in. Now, before you go on, you need to understand the different market phases. The first phase is the accumulation phase, okay, where markets build up liquidity to push price upward. Now, after the accumulation phase here, which is the consolidation area here, this push up is called the markup phase. This is where the trend begins. Now, after a prolonged trend, market will need to have a breather. It slows down, okay? When it slows down, it either do two things. Either it continues going higher or reverse. If it goes higher, then this phase here is called reaccumulation. But if it comes down, this phase becomes distribution, where market will manipulate the highs. So we have another phase here, and a push down. We have another one here, and a push down. So now this first phase is called the accumulation phase. Accumulation phase in the sense that it manipulates the lows and then break market upward. This push upward is the markup phase, as I said earlier. When it moves up, it needs to take a breather. It consolidates again and then move higher. This consolidation here simply means reaccumulation because it reaccumulates, manipulating the lows and break structure to the upside. So this is another markup, another trend starting here. Then once that is done, it gets to a point where market will need to reverse, means that it manipulates the high and breaks structure to the downside. So this trend down here is called the markdown, okay, or a bearish market. Same thing happens after it moves down. It will need to slow down, consolidate again, creating what? Redistribution. Market manipulates the high and then goes down. When you look at the monthly time frame here, you can see this level here is market accumulation, manipulation of the lows, and a push higher. Okay, this is the accumulation. Market came back down here, breathing, slow down, push higher. Okay, then creating another form of what? Distribution here, manipulating the highs and then going lower. So these are different market phases. It happens every time. Whenever you see consolidation, simply see it as either an area of accumulation or an area of distribution, all depending on where the market push to. So you need to understand that before we start moving ahead. Smart money is simply institutional money. That is the money that big players use while trading the forex market, stock market, crypto market, or any other financial market. The term smart money simply means that this money traded by institutions hardly loses. And as a smart money trader, we are only trading in the footprint of these big institutions, because the big institutions leave footprint behind. Therefore, as a smart money trader, it is your duty to understand and know the footprint whenever you see them on the chart. A good example is when you see a very strong candle being printed on the chart. Okay, that simply means that the institution are the reason why that price moved that much, because you and I, the retail, cannot move price by that margin. Hence the need to study smart money concept. Now, why do you have to study smart money concept? Number one is a different strategy entirely that can help you become profitable in the forex market. Number two, it will give you an in-depth understanding why price moves the way it does. Why does it move from one particular level to another level? These are the things you are going to learn in this course now. So without wasting time, we are going to start with the fundamental key when it comes to smart money concept, and that is market structure. Market structure, in a simple form, in a bullish market, moves from a low to a high, creating a lower low, higher high, lower low, higher high, lower low, higher high. These are simply in the simplest form. Okay, meaning that when price moves from this level to this level, it has to get to a point where it needs to retrace. So this move up here is called an impulse leg, and the move down is called a retracement, or sometimes you call it correction leg. When it give back that correction leg, that means a new high has been formed. Now this high is called higher high. So once the higher high has been put in place, then there's need for a retracement. As long as that retracement is not deeper than the previous low, then this is called a higher low. From this higher low, price will move up. If it breaks this previous high that was created, the next high becomes the higher high, and then this high will need to correct. The move will need to correct or give a pullback. That pullback, as long as it's not below this previous low, becomes the higher low, because this low is higher than this low. This high is higher than this high. Okay, this high is higher than this high, and this is why it's called a higher high. And so on, price move up, creating a higher high and a higher low, higher high, up to a point where the market may decide to reverse. And in that reversal, price will need to break this previous low here. Once this occurs, this simply means an early indication that we might be having a reversal at our hands. For a bearish market, we have the price moving downward. We have a bearish trend, and for you to confirm a bearish trend, the market must create series of lower lows, lower high, lower low, lower high, lower lows, lower high. What does this mean? You train your eyes to see that the low that was created here created a correction, because this move here is an impulsive move for the bearish market. Then it created a correction or a pullback. That pullback will end with a particular high, which will be lower than the previous high. Now this high, if we move down to break this low, then we have a lower low. Why is it a lower low? Because it's lower than this previous low. Then once the low is put in place, it has to correct. Price will come back in here, creating a correction, forming a lower high. As long as this high do not trade above this high, we have a lower high, because the high is lower than this one. Then from there, price will continue its trend to the downside, creating further a lower low. Once this lower low is in place, then there's need for correction. So the pullback, different terms, you can call it pullback, I call it correction, you can call it retracement. It does not matter. They all mean the same thing. Then the price will continue. So this trend will continue that way until the market breaks the last lower high, therefore giving an early indication of a market reversal, not a complete market reversal. It's an early indication. I'm going to show you when you have a complete market reversal in your hands. Okay, so stay till the end. A simple hypothetical illustration, but you and I know that when you look at the chart, we don't see the market move as simple as this. So let's look at more advanced market structure. Now let's look at the real market structure, the way it appears on your chart. And in a bearish market, this is how it appears. It doesn't look straightforward like what I've shown you in a hypothetical simple way. So market move down, move up, creating a low. Before it creates a lower high, it creates a leg here, came back down, then push higher. Okay, so that means this all from this level to this level is your higher high. So the market came back down here, creating a low, went back, create an high, came back here, creating a lower low. Why is it a lower low? Because it's lower than this. Now, in this case, we have a complex pullback. Okay, this is what we call a complex pullback because it didn't just give one straight leg. It gave multiple of what? Internal structure upward. So from here, it went up, creating a high. That I tried to attempt to take this low, but it could not. Then finally creating a lower high in here. This lower high is lower than this low, this lower high up here. So from here, you can see the market broke that level. Now, when it breaks, this is what they call a typical break of structure here. Okay, in this case, we call this a BOS. Once market breaks that lower low, becomes a break of structure. Then it push back up. Now you can see I didn't label here as a lower low because by the time this plays out, but when you're looking at this in the first place, this becomes what? Your lower low. But this is a complex impulse leg. Okay, you don't have one straight leg coming down. So it went down, creating a lower low at first. This high, because this high didn't create this, you can't call this one a lower high. That is after the effect. But before this move happened, you can call this one a lower high initially because you don't know what will happen on the right hand side. So at first, this is how it is here. Your lower high, in this case, this one becomes your lower low here. Okay. But as price move up, breaking this, as I said earlier, this is an early indication that probably we might be having a change of what? Market structure. But as it happens, for you to have a complete change of market structure, you need double break of structure. Okay? This first high that created that break of structure needs to be taken. But as you can see, price did not take that high, and instead it went lower, creating a lower high here. Another lower high, then before it got this low broken. Once this low is broken, that means the bearish market is still in play. This is a complex situation, and this is how the market operates. So if, for example, you try to sell in here, you will take a loss. There's no problem with that. You have to deal with it. But know that before the market can change trend, market needs to trade above this one. When you have the first push, this one now push up, taking out this, then we have a change in market structure completely, because you have the first level gone, then the second lower high gone. But as long as the second lower high is still intact, this one here, not this one, if this one gets broken but not this one, then the bearish structure is still in place. So these are the kind of things you give to yourself as time goes on, when you look at the market structure, you will give yourself some certain rules. I give myself certain rules to use in order for me to understand if the trend is over or if the trend is just beginning. So as you can see here, market came, these are simply complex pullback, creating a low, a high. All of these are internal highs. So this lower high here is simply an internal high, which serves as what? Liquidity, inducement. This is inducement for the unmitigated POI in here to work. Okay, so you have to take note of all of this. There are no rules for you to know which one is inducement. Everything, every high and low in the marketplace is an inducement. There is no particular rule that say, okay, the first pullback, the last pullback, the first this, the last that. No. If anybody is teaching you that, it's just selling you fantasy, dream. Listen, every eye, even this eye here, is an inducement also. Because sometimes price may just sweep that eye and then continue. Your duty as a trader is not just to be very accurate. Your duty as a trader is knowing when to get into the market and when to get out of the market. So if you take a trade here, for example, and the market sweep you, there are other entry criteria you can use in this case to also continue bearish. Okay, I'm going to show you what is considered a break of structure and what is considered a liquidity sweep. You see, for you to have a break of structure, you need to have the body close above this eye. For example, if you go below here, let me just take this as a random. If you want this level to go, okay, this first candle, let me make it big. This first candle that came up here did not break this high. Okay, for me, I don't consider this a break. To others, this could be a break. There are no problem. Okay, if the rules that you set for yourself is okay by you, there's no problem. I will not have any issue with that. But for me, I want to see a break, a body close above that swing high that I'm looking at. Once there's a body close, it can give me indication that, okay, definitely we have a what? A break of structure. But as you can see, this market is bearish here. This market has been bearish, low here, high, low. In this case, we want this high to go. We want us to continue going if there's going to be a change of market structure. But as you can see, we only close above the internal high, tap into a demand zone, a supply zone somewhere in there, and then we continue going lower. So this high that you have here initially was the lower high, creating a low, even though the low didn't break this actually. Okay, but if you look at this other side, this high took out this. Now this high created a low. We have a low here. In this case, we don't have a break here. Okay, we do not have a break. So this is not the break of structure. Where do we have that break of structure? Yeah. Okay, this is where the break of structure is. So that means everything within here, within this low here, are simply liquidity that price needs to take. Okay, so this is the high and this is the low. So you can see how complex the market might present itself. But don't worry, I'm going to give you a rule to use at the end of this course so that you understand when to tackle the market in the way of structure and when not to tackle the market in the way of structure. So in order to understand market structure properly, we need to blend it with liquidity. Liquidity, your understanding of liquidity will help you to navigate this properly. Okay, now let's look at the bullish side here. So looking at the bullish side, we have a low here, creating a high. This high didn't give us a clean retracement, instead it gave us a complex retracement, creating a low, higher high, like a minus structure here to the downside, which might be a trend in the lower time frame. Okay, all of these are simply the internal structure high and lows. Okay, look at the external here. Now when you're taking a trade in here, you are targeting this external, not the internal. The internal here are simply liquidity. Okay, so you don't have to be confused. Know where the price is coming from originally and where it ended before breaking this high. Okay, now this higher high created a higher low in here, and this higher low push higher, breaking above this. But if you notice something here, we have a break of this. Because market break this doesn't confirm a change of what? Market direction. This doesn't mean it's a change of market structure, because it only took out one higher low. For you to have a complete change in market structure, you need to take out the origin where it started from to create this high that was broken. That low that created this high that was broken needs to be broken in order to confirm a change in market structure. So this might just be a liquidity pool tapping into an unmitigated point of interest, which I will talk about with time. Then from there, price move higher, creating a higher high, breaking structure. This is also creating a pullback. Okay, the price did not go below this. Then from here it continues. So the market is very complex. It trades a complex scenario. That is why most traders struggle. But I'll try my best to show you the real diagram in a market with candles and the rest, and we're going to break down this market structure. So let's quickly analyze this market structure here for this daily chart of Euro USD. Now let's start from here and see where the structure is. Now you can see we are bullish here. Okay, we are bullish in here. Let's see where the structure is here. So as you can see, we have a push up and then we broke this low. Now you can see this is a low. Let's start from here. This is a low. A high was created because it did break above there. No, we finally broke here, so it produced this high. So a low, a high. This is a lower low. Whether you like it or not, sometimes your pullback may not be that strong. This is a lower low, because before now, everything on this left, you can't see it. So you need to label your chart. You can't see anything on this left. For example, if I take this replay and I put it this way, you can see how it is now. You have to label. Okay, you have to give the lower low until it breaks. But for you to break this structure, I want this leg to go. This is the leg you want market to break before you have a break of structure. I mean, before you have a change of market structure. That is from bullish to bearish. Okay, so let's cancel this. So forget that this side, just pay attention with me from here. This is a low, this is a high, this is a low, this is a high, this is a low, this is a high. Now when market broke this level, this is an early indication. Okay, this is an early indication that the bullish market might be over, but it's not yet over until market takes out this one as well, before you can start looking for trade to the downside. Okay, because this is what they call double break of structure. When this break, so there's a tendency for price to tap in here and then continue higher, because if you are bullish on this pair, you'll be looking for trades in here, especially once the liquidity is taken one way or the other. You'll be looking for trade in here. That is the logic. Okay, do not allow anyone deceive you by saying, okay, you know exactly what will happen in there. No, you are going to go bullish until it becomes bearish. That is how you trade, and that is where you might have your losses. At this reversal point, these are where you might be having losses if you are going bullish. But the moment you understand what I'm showing you here, at least to some extent, once you see that this low is taken, the first low is taken, then the second low is taken that produce that high, then you have to now start switching to a bearish stand. And you can see here, price have to come back and mitigate this supply zone before what moving. After breaking this level, you might wait for price to take out all of this as inducement. I will talk about liquidity once I'm done with this market structure breakdown. Okay, now all of these are simply money seated here. All highs and lows on the market is money. Okay, so when price broke that low, it created a low here, creating another low, high, low. Now this low has confirmed what? A lower low, creating a what? A lower high. From here it got broken, creating what? Lower high here. Okay, creating a lower high, lower high. You can put your swing points here. You can have as many as possible, but these are simply internal range. Once this is created, it created lower high because this low did not break this level. So your valid lower low is here. So in this case, it pushed up, creating a what? Lower high. Then from here, we broke this level, BOS, creating what? Another lower low. Now you can see that price took out this high. This is an early indication that we might be going bullish, but we did not have a break above this high here. Forget the line there. Let's use this trend line tool. Okay, now if you look at it very well, I know someone will say this is a break here, but if you watch my London session strategy, this is a fake out, a break up and then a breakdown immediately. This to me, I will consider this as a fake out unless this high gets taken. Okay, so in my rule, this is not a valid break of structure. So the bearish market is still intact. What happened here is simply a liquidity grab into an order block in here to continue going lower. Okay, so this is our lower low that we need market to take. Yeah, and you can see we have that break there. This is now the high that was created, the lower high that was created, and in the process there are internal highs. Yeah, all of these are simply liquidity, and you can see once price take out this liquidity here, tap into an unmitigated point of interest, creating another lower low, and so on. Okay, so you have to just, there's no perfect description to it. You just have to use your intuitive, your knowledge, your experience, what you've gathered so far, apply it to it. Like here, we have a break here, but you can see, if you zoom in, a break, immediately a close below, and even closing below this candle. Candlestick formation is also important. So this is simply a liquidity grab, a fake out, and the market continue going lower. But if you don't understand that, you definitely try to take a trade in here, thinking that that is a break of structure. It gave you a reaction and then collapse, and this will continue until you have a real break of structure. Now you can see creating a low here. This is a sweep. Market came down, break this low, creating a high, but this high didn't produce a new low. This is called a weak high. This is also a weak low, and so on. I will talk about that during the liquidity section. Like this video so far. If you like it, share, and then comment. Let me know your thoughts in the overall delivery of this video. If you understand, and if there's anything you want me to talk about, kindly put it in the comment section. So you can see price came up here. All of these are simply internal structure. They are simply internal structure, and they are liquidity. Market needs to take it up. You can see a break above and a close below. These are simply fake outs. Okay, these are simply fake outs. When market comes below this, as we're taking this liquidity, breaking below this candle, this is a engulfing pattern, which signifies a strong bearish move. So you have to combine, even as a smart money trader, you need to understand the basic understanding of candlesticks formation as a single candle or as multiple candles. You need to understand the way the price action behaves. So you can see this is not a break of structure. Why? If initially you were looking at for a break, remember this is where your point of interest will be. Okay, but the moment you see this candle closing back down immediately, okay, then you have to question that move, because this is not a break of structure. Instead, this is a fake out. Okay, now you look at the complete break of structure here. We have a break here. This didn't come back immediately inside that line. Okay, so this is a break. Even though market came back down, you can take your trade here and continue going. Let's look at the valid break of structure here again. This is a break. This candle did not come back immediately inside. Okay, so that confirms a break. Okay, if you want to confirm a break of market structure, do not allow the same candle that breaks it, then the next candle come back in immediately. That is not a break. Like here, if you want to consider this a break, this is a break, okay, because the next candle did not come up here. But remember, you are in a bearish market. You want to be selling, okay, you want to be selling and not buying. The only time you'll be looking for buy is when the market takes out this, which is a double break of structure. This now confirms this shift in market structure. This first one can be considered a chop. Then this is a complete break of structure. But you can see the eye or selling time. When market comes back here, you can look for scalping probably. But once it gets to the unmitigated point in here, you try to sell. Okay, everything in trading is probability. You stack the odds in your favor. This is not a break here. In this case, you have a break. You can see the next candle breaking below. How do you know when there's a shift in market structure? Okay, as I've explained, we have a high here. It produced this high first of all, came back here. So this is the high I want market to take. This is the high that is very, very important, not this one. When this one created a low, a first break of structure is here. This is the first break of structure because this is the last low that put in this is the last high that put in the low. The first push down and up, this is not it, because there was no break of structure first before this. This is the first break of structure before this second one. So this is the high. So when market took out this high, this is simply an early indication. Okay, when there's an early indication, and you can see this is simply form of what? A fake out. Okay, breaking up and then coming back in. You shouldn't be satisfied with that yet. This is not a break of structure, so probably you can keep looking for a bearish move until probably you are stopped out. But this high, now what you need to look for here is, you want, when this market is coming down, you want this market to break the lows. Okay, you want the market to break the lows, at least to give you reason for you to start selling in here, to continue that bearish move. But when you see that the market did not take out this low, this becomes a weak high. I'll talk more on this during the liquidity section. This becomes a weak high, and as a weak high, it becomes inducement. Okay, now when a weak high is created, most times it makes whatever in here weak. Okay, that is creating what? Equal highs, and the market needs to take that equal high. So this is the perfect place for you to start looking for sell. Okay, this is the perfect place for you to start looking for sell in here. But the moment you see a close above here, market push out here, creating a sweep, then a break. Now this market coming back down here might give you that scare, but look at what happened before it. We have a push already in before that break. Coming back down, then we completely have that break of structure here. Then from there, the market, now in this case, we have a change of market structure. So the market structure now is bullish, and we have been that bullish. If you look at it from there, we are still very bullish when it comes to the Euro USD trade here. Okay, so now, do we have a change of structure here? Before we can have a change of structure again, we need to close below this low. Why? The first break here is simply an early indication. Okay, we have a break here, and this candle broke this. You can try attempt selling, but technically this market is still bullish. Forget the first break of structure. That is simply an indication that, okay, maybe the bears are coming back stronger to take out this low. But until this low is taken in terms of breaking below, we are technically bullish. So market may still do something like this and trade upward and continue that bullish move. But if this low is taken, then we are bearish and we start switching, looking for ways to sell the market once it gets to unmitigated demand zones. So that is market structure in a nutshell, in a simple form. So let's go to liquidity. Now this is the bread and butter of smart money concepts. If you are studying smart money concepts but you don't have a deep understanding of liquidity, you are going to struggle with that strategy. Okay, so how do you identify liquidity? There are different types of liquidity. The first one is swing high and low. A swing point is when you have 3 candles and the middle candle is either the highest or the lowest, including the wick. When you hear the word swing, this is what it means. Like in this case, we have a swing high. What you need to be looking is look for 1, 2, 3, where the second candle is either the highest or the lowest. When the second candle is the highest, then it becomes a swing high. When the second candle is the lowest, it becomes a swing low. Now, every swing high and swing low in the market are simply liquidity. But there are times you can identify if the liquidity will be taken or not. And that is what this liquidity section will talk about. We are going to look at how to know which liquidity will be protected and which liquidity will be taken, at least in the short time frame, because in the long run they will all be taken. Okay, so your swing highs and swing lows are simply liquidity points. For example, this is liquidity, this is liquidity, this is liquidity, this is liquidity. First 1, 2, 3. Second candle, swing low, 1, 2, 3. Second candle is higher, swing high. Now you look at this one, 1, 2, 3. This is not a swing because the second candle is not the highest. 1, 2, 3. No, the second candle is not the lowest or the highest. Okay, so for you to know the swing point is very simple. Look for 3 candles. Second candle is the highest, second candle. So this is a swing point. Even if this one came back to take it, so this is another swing here. Okay, these are swing points. They are all liquidity points in the market. Old highs and lows are liquidity points. Regardless of the time frame you are looking at it, all of these are liquidity, because liquidity is what moves the price in the forex market or in the stock market, in the crypto market, any other market. It is liquidity. Once market takes out the low, there's tendency of it to retrace. Okay, that's why when you have an high that has been taken, there's tendency for it to have a pullback. Now the second one is simply previous day, previous week, previous month high and low. Okay, this does not need to be a swing point. For example, this is a daily, this is a monthly time frame here. So at the end of the month, the high and lows of that month are liquidity points. The high and low of this month is liquidity point. Like for example, when price took out this high and came back down, based on a smart money concept where we call liquidity sweep, which I taught in this channel. If you don't know it, there's a video I'll put in the link or see it up here. When you see such a move, then you should know that market might be going lower. So why is this important? Because at the end of the day, money is seated. Where the price traded to is money. Where it traded down to is also money. So market will need to move towards those liquidity points, either to continue the trend or to create a reversal. Okay, like in this case, Once the previous month is taken, there's tendency for it to go down. But once the market is bearish and then the last month that took out that low get broken, then two things need to happen. Either the market will start reversing, or it might be stuck in a consolidation. And that is what happened in there. Once this swing high here, this monthly high was taken, you can see what happened. The market was in a consolidation before moving up, and then probably continue going down. Okay, these are deep concepts which I will not share more here. But however, I have a mentorship where if you want to learn more, you can use the link in the description to join the mentorship. Only if you want to learn more. Everything I provide on the YouTube channel is okay for you to become profitable. Your previous day, previous week, previous month high and lows are simply what? Liquidity. The next liquidity point are simply sessions high and low. Okay, in a forex market there are what we call sessions. Okay, we have the Asian session, we have the London session, and we have the New York session. So now, as a smart money trader, for you to understand how to trade smart money, you have to understand these sessions high and low. Asian market mostly trends. Okay, London market follows after the Asian market. Then after the London market, we have the New York market. So each of these sessions have their highs and their lows. As a trader, you need to understand this high and low so that you use that to create your own trading plan. Now, the tool I use for my session timing is simply Asian session range and week and day separator. What this helps you to do is to understand the liquidity point of each session. So once the Asian session, this is the Asian session high. Okay, so it's a key level for you to use in your trading. This is the London session low. This is the high of the New York session. So every high and low of the session are also liquidity points which you can use. If this, for example, is within an unmitigated area, for example, for any reason, you can attempt buying in here just because this New York low is just below, is just above the unmitigated point of interest where you expect price to push up. But in this case, just went up a little and then come down. It happens like that, but you can use it like that to make informed decision. For example, here you can see this level here. This point of interest is simply above the Asian high. This Asian high now serves as what? Inducement. Okay, London also created that before the New York session came in and then continued going lower. So you can use this in making or building up your strategy. So take note of that. The next one we have to look at is S&R liquidity. Now, what do I mean by S&R? This S&R simply stands for support and resistance. Okay, for example, we have a typical support. The way it's been taught is a zone where if price approach it, we expect it to pull back down. Okay, like this. So what it means is that the first touch, second touch, the touch, we have to buy as trader. That's what we were taught when you follow the basic support and resistance. Same thing with the resistance here. Where price finds it difficult to break is a resistance upward. Where price finds it difficult to break down is a support. So all of this region, this support and resistance region, is simply liquidity. Now it is believed that smart money most times will try to trade below all of these. These are simply early buyers. If the market was to go higher, there are early buyers that will come in here, but the smart money comes in, sweep this liquidity before moving up in the intended direction. So as a smart money trader, you won't be looking for trades in here. You simply trade all of this as liquidity. Okay, where market might sweep, look for an unmitigated demand zone or other block, whatever point of interest you have identified, fair value gaps, whatever it is. Look for it and use that as what? As your trade, because this will serve as what? Liquidity inducement. for that point of interest to move higher. Okay, same thing with the resistance. Once price sweep up those liquidity, tap into an unmitigated point of interest, you can decide to look for a trade to go short. These are simply things you have to understand as a smart money trader, because at the end of it, you are going to use them in making key trading decisions. Another one you can do is trend line liquidity. Okay, trend line in the sense that there are traders who trade trend lines. Now, I'm not saying support and resistance do not work. I'm not saying trend line do not work. But as a smart money trader, these are concepts we use to make our trading decision. Okay, for example, here, when market is trending, there are people that trade trend lines. Okay, what do? They buy at the touch of that trend line and they sell when there's a break of that trend line for a bullish market. And for a bearish market, the same thing goes. Okay, they sell at the touch of that trend line, and once it broke, they will buy. Simple. Now, all these trend lines too, you can look at them from liquidity perspective, because money is seated here. Okay, once you have a smooth trend line, you have to be careful trading on that trend line, because the point of interest created in here might be a trap. Okay, that's where traps comes in. People with, if you don't understand this as a smart money trader, okay, you'll be looking for trades in here, whereas those are liquidity that market needs to take, okay, before heading high. And they all serve as inducement. Inducement in the sense that they are inducing you to take a buy or a sell. Okay, so as a smart money trader, you train yourself to know when to be buying within this liquidity point. Okay, and also for a break, there you don't need to be looking for trades in here. Okay, you don't need to be looking for trades at this point, because most times when it got broken, it tends to sweep all of this before moving lower. Another powerful concept you need to understand as a smart money trader is the concept of strong high, low, and weak high or low. This concept will help you avoid traps set in the market, and it will help you understand or use it as a form of what? Directional bias. A strong high is simply an high that takes liquidity and also breaks structure to the downside. Yeah. Okay. The market moves up, take this liquidity, and then comes down, breaking the structure. This high is strong in the sense that you don't expect it to be taken. Okay, you don't expect it to be taken. And the weak low is simply a low that fails to break structure. Okay, when a low moves and do not break structure, it becomes liquidity, and that is where you can take a trade here to target that weak low. Simple as that. So if market is trading around here, you know your directional bias will be what? Bearish. Why? Because you want a market to target this low, the weak low. This is a strong high. And also, a strong high will always produce a weak low. Okay? Two things for a strong high: sweep liquidity, then break structure. This is your typical chop. Okay? Same thing for a bullish move here. This low took liquidity, yeah, and broke structure to the upside. So this high failed to break this low. This makes it a weak high. This is a strong low. And you don't expect price to trade below this strong low. So this gives you an objective reason for you to look for trade in here, and your target will be the weak low. So this concept is very, very powerful. So let's take a look at this level here. You see this high? This high is a strong high. Why? Because it took out liquidity. This is the liquidity it took, and it broke structure. Yeah, it broke structure. This is a swing structure that was broken. So you don't expect price to trade above all of this. So when price comes to this region, you can decide to sell and target this low. This is your weak low. Okay, then you continue like that and move forward. Okay, this is a strong eye. Why is it a strong eye? It took out this liquidity, it broke structure. So when price is heading up, you can have that objective reasoning to look for trade in here to target this low. Simple as that. And you continue that way. That strong eye should not be taken. Okay, another one is here. This eye here took liquidity, did it? Okay, let's look at the eye before that. This eye, this is a strong eye. It took out this liquidity, it broke structure, so we don't expect price to trade above it. Okay, even if it does, then this makes it a strong eye. Yeah, but you could have taken, when this break happened, you could have taken a trade here, actually giving you a trade before it finally invalidates that, creating another strong eye. This is a strong eye, broke structure, and as you can see, you can, when price comes up in here, you can look for trade in here. Now looking at this, you can see that it's not an holy grail, because price later came back up and then swept that eye. That doesn't mean this is not a strong eye. That doesn't mean your analysis is not correct. Sometimes things like this happen, and that is why it's trading. You have to use your proper risk management in this case. So you continue that way. So this becomes our new strong eye. So we don't expect price to take out that eye. The price comes back there, price didn't come back there, we continue trading. This is a strong eye. It took out this swing point. This is a strong eye. It took out this swing point here, and it broke structure. So you can take your trade once price gets to that level, to the extreme. You can see there was a move in here, and so on and so forth. This is a strong eye. It took out all of this liquidity, broke structure. So that is a strong eye. So you can go to the chart and then look for strong eyes and strong lows in a bearish market to start taking your trades from there. In this case here, we have a strong eye, took that liquidity, broke structure here. So when price comes back in here, you can look for your trade. Okay, remember, nothing is an holy grail in forex. You have to apply objective reasoning in dealing with things. So we can identify another one in here, but this one happens not to hold. Okay, even with all the liquidity inducement and the rest, it didn't hold. It happens. You take a loss there and you move on. So the same thing, opposite is the case for a bullish strong eye and strong low, weak high, weak low ideology. Like here, you can start the beginning here. This is strong eye in the sense that it took out this low. Strong low in the sense that it took out this low here, this liquidity, and broke structure here. Broke structure here. So when price comes back down to any of these points, you can start looking for buy to continue going higher. And this is where price is currently. Okay, here is a strong low, so you can also look for a trade in here. So this is the current situation. Price came in here and pushed price upward. You could have profited one way or the other. So our next section is the point of interest. Now, point of interest or area of value, if you may call it that way, are simply areas you want to start buying or selling in the market. These are areas that you highlight on your chart, that when price comes in there, you want to start buying or selling. For example, if you have a break of structure, for example, you can identify point of interest or area of value. This is simply an area where you, as a trader, place on the chart. That when price gets in there, that's where you want to sell this market to the downside. Okay, so these are area point of interest or area of value. For a bullish scenario, you want to, this becomes your point of interest, yeah, where you want to start engaging. In your trading plan, you must have a point of interest. Now, there are different types of point of interest. In smart money concept, a popular point of interest is the order block. These are simply the last bullish move before the reversal, meaning it could be one candle, it could be a series of multiple candles. These are simply the last push upward. In this case, let's look for an example here. So this last push upward here is an order block, okay, before the market moved down. But in this case, it didn't break structure. But you can look at this area. So in this case, this last bullish candle is simply a bearish order block, okay, where when market comes back to that area, this could be your point of interest, okay. The entire candle is a point of interest. It's the last bullish push before this move down, okay. And you can easily, when price comes in here, you can look for a sell. And it's also a flow from this level to this point is simply your order block as well, because if you look at the higher time frame, from this level to this point is an order block, okay. An order flow before a switch, that's simply an order block. So your order block is one point of interest. Now, for you to start trading order block, because order blocks are everywhere on the chart, they are everywhere. When you look at the chart, you will see order blocks everywhere. Are you going to be taking all these order blocks? No. Okay, that is where you give yourself a plan that I will only take an order block that takes liquidity in terms of taking a high or a swing structure, and must have a fair value gap when it moves downwards. For example, we can look at this order block here. This is an order block. Why? It took out this previous candle. This liquidity is still very valid. Even this can also serve as one, okay. Then it creates a fair value gap in here, okay. We have a fair value gap here. So when this breaks and price stays back to the fair value gap, you'll be waiting for price to tap to your order block. But in this scenario, it did not tap in there, okay. You don't need to worry whatsoever. Like here, this order block took out this high here, liquidity. Then when price tapped back on that order block, you can initiate a sell, and you can say price react from it. Now this movement, you can go to a lower time frame and refine. Okay, we'll get to that. Now these are the kind of order blocks you may not want to trade. There are no imbalance here. When it took out this, the last bullish bearish candle before the move up, this push down, this push up did not create imbalance. So you are going to use another kind of point of interest to trade this, not order block, okay. This is another block, okay. Now the body of the candle, the color of the candle does not matter here. When it takes liquidity and creates fair value gap, that is simply your order block, okay. When price trades back in there, you can take your sell. Take note of that. Now the second point of interest we want to look at is the IPA. IPA stands for imbalanced price action. To identify an IPA, imbalanced price action, you need to look for 3 candles, 3 bearish candles for a bearish IPA, and 3 bullish candles for a bullish IPA. So what you are looking for within these 3 candles is the first candle and the last candle wick do not touch. Okay, you can see the wick stop here for this one, and this other wick stops here. So we created a fair value gap in between. So the candle up here becomes an IPA candle, okay. the candle that closes the imbalance. Okay, if price decides to trade up in here and closes this imbalance that was created, this candle that closes it is the imbalance price action. Okay, so this is the point of interest where you can look for trades to the downside. The same thing happens for a bullish move. The candle that closes that imbalance, which is this one, okay, is your IPA, meaning the candle when price comes back down to close this imbalance that was created. This candle is the candle responsible for that. This is your point of interest where you can be looking for trades to the upside. So that is an IPA. Let's go to the chart and see if we can see any form of IPA candle. We have 1, 2, 3. Okay, in this case we don't have a bearish candle, but this candle here created a fair value gap. So that fair value gap, the candle that closes that gap, this is your IPA candle. Okay, this is your point of interest. Point of interest in the sense that when price comes back in there, you want to be selling from here. That is the point of interest. So we are going to look at a way where you can know if they are going to be successful. But first of all, as a beginner, you need to understand how to mark out your point of interest. Another one is looking at this bearish candle 1, 2, 3. There's an obvious fair value gap in there. This candle now that closes that fair value gap is your IPA candle. Like here, for example, we have a fair value gap in here. So the candle that closes that is this candle here, is an IPA candle. When price tap in here, you can decide to take the trade here. Okay, this is a point of interest. The same thing with this candle. This candle also is a point of interest. You see, not everything is order block. Okay, this candle is also a point of interest because it's a candle that filled up that imbalance. In fact, the imbalance was filled up in here. So in here you can look for a point of interest. You can look for a way to enter the market for a short. Same thing for bullish IPA. This candle, sometimes the order block can serve as what? An IPA candle. Okay, these are the candles that closes the imbalance here. And you can see from there we have a push to the upside. Here is an IPA as well. This is an IPA candle. Price came in there before pushing to the upside. In this case, we have an IPA candle here. Fill up this imbalance. Price played a little bit in, then broke down. In this case, we continue going lower. Not all cases this will work out. Remember, in smart money concept, you are only trading based on probability. You want to stack the odd in your favor. So this is an IPA candle as well, but price will not get in here. So I believe you understand what an IPA candle is. Candle that fill up the imbalance. These are IPA candles. Okay, so let's move on to the next point of interest. The third point of interest I would like to share here is supply and demand. Okay, and we have supply and demand point of interest in a continuation trend, meaning if you want to continue the trend, we have here for a bearish trend, we have drop here. Base are simply the consolidation, and we have another drop. So how do you take this? You wait for price to trade back up in here and then execute the trade. This becomes the point of interest. Point of interest says that you want to be taking trades in here. And then with this also, this is a rally, base, rally for a continuation of the bullish push. So when price come back to the base, this is your point of interest where you look for trade to the upside. Also, we have for a reversal, a bullish move, consolidation, and then a reversal. That means this is a rally, price rally to the upside, base, consolidation, and a drop. So when price come back in here, you can look to take a trade from there. Okay, this is also a point of interest. And then for a reversal, for a bullish push, a drop, rally, which is the base, a drop and the base here, and then we have rally. So this base becomes your point of interest. When price come in, this is where you want to buy. Now the last one is the fair value gap. FVG are simply imbalance in the market. For example, this candle and this candle, just like the IPA candle, but in this case, you are not marking the IPA candle, you are marking entire imbalance. Okay, this imbalance is called the fair value gap. Also here, this imbalance here is called the fair value gap, where when price come back in there, you will take your trade. But on my end, I hardly trade based on the fair value gap. I don't usually trade on the fair value gap alone. I only use them. I trade the IPA candle most especially. Okay, so that means I have to wait for the imbalance to get filled before I execute my trade. So that is why I didn't want to include it, but for you, you might have a way to make it profitable for you. So I'm going to include it here. So this IP. So you go through the chart, mark out your fair value gaps. Okay. And then those are where you take your trades from. So next is to put everything into practice and look for entry. Now, before we look at entry, there are two types of entry you can take as a smart money trader. The first one is risk entry, and the other one is confirmation entry. The risk entry is when you identify a point of interest. Okay, let's say we have a kind of structure like this, for example, and the market went down, and you've identified here as the point of interest. Risk entry in the sense that when price approaches that, you simply take your entry from there with a stop loss just above that point of interest, maybe some few pips above, and then you look for a target below. This is a risky entry. Why? In the sense that you did not take any form of confirmation. You just rely on that point of interest. Now, this is a good way to look at entry, but it has its own downside and its own con, because most times it might lead to a lower win rate for you. The other form of entry is what we call the confirmation entry. The same scenario, but in this case, as price approach here, you are going to go to your lower time frame. Lower time frame, okay, to look for confirmation. Now, what are you looking for in your lower time frame? Now, let's assume this is your lower time frame, price approaching. You want to see a chalk. Okay, a chalk simply means we have a shift in market structure. Okay, everything is just a fancy name. Simply a shift in the market structure. So that chalk now have another point of interest. Okay, so you are going to take trade based on that, because the reason why you want this is because you want to have an early indication that the trend might, this bullish trend there will change for us to now have a good trading setup on our hands. And the advantage of this is that price will give you, or the setup will give you, a very high risk to reward. Meaning, if you are risking, just imagine you taking a trade here now. Instead of your stop loss to be above here, your stop loss will be below that, and then giving you a more higher risk to reward. Like in this case, we have a 3, in this case we have 4.5. If you go to a lower time frame, in fact, you can even have a stop loss as very low that might give you up to 10 out trades. Okay, the disadvantage of that is that, number one, price may not give you that pullback again. Immediately breaks this, it might start trading lower without coming to your point of interest that you identify in the lower time frame, and then the market leaves without you. But with the risky entry, you don't have to miss trade. Just that in the long run, it might give you a lower win percentage. So we can see that this might be this is our point of interest here. Okay, is either we take a risk entry once price tap in here to move, or we look for a confirmation. Okay, so we are going to look for a confirmation entry in the 1 hour time frame. Okay, so let's see how we could do that. Remember, we need a double break of structure, so we play price. So right now price is within our point of interest here. Now you can see that as price is approaching, you have to mark out a high in here that you want price. Immediately price take this low, you want price to take this high, but it did not. It traded on that low. You want it to take this, it did not. Traded on that low. Okay, you want it to take that low, it did not. Traded on that low. What is the recent low that was created before the what is the recent low? This, which high created that recent low? This is the high. So this high, now we have a break above it. Now this is where your understanding of different point of interest comes in. In this case, you have a rally based rally. So in that note, this is what you should be looking for. If you look for rally based rally, you will have gotten a trade in here and then profited from this. If you are looking for fair value gap, we do not have any form of fair value gap in here, do we? Very tiny amount of it. And the question is, the price come in there, price did not tap into that fair value gap. So if you are looking for fair value gaps, you will not be tapping. And if you are looking for other block, the last bearish candle before the move up, but in this case you are not tapping. So you need to practice more and more of this. I will do a follow-up video for the entry criteria so that you can go away with it. So this is the trading plan for you. If you have stayed to the end, the first thing is for you to understand market direction. Once you know the market direction, that the market is either bullish or bearish, the next thing is to identify the break of structure. Then from there, you understand your point of interest, look for liquidity, and then you look for entry. Now your entry could be risk entry or a confirmation entry. So this is what we use in applying for this trade. For example, we understand that the market structure is bullish. From there, we have that break of structure here. This is a break of structure. Now from the break of structure, look for your point of interest. This is the point of interest here. Look for liquidity. There are the liquidities in here. All of these are simply liquidity, trend line liquidity. Okay, price took them out, and then you look for your entry. Your entry could be at the touch of here with stop loss below, and then watch as price move higher. Okay, or you go for a refinement. You got the trade, but if you don't take your profit out, you can see price later came back, sweep that low before moving higher. So all of this simply requires you to practice. I'm putting this out here not for me to show you a perfect entry, but instead I'm showing you a blueprint that you can go and practice and then come out to become a better forex trader. I believe this course is useful. If it's useful, give me a like, subscribe to this channel, and I will see you in this video.